When Treasury-backed stablecoins were quietly written into legislation, most people missed what was really happening. This wasn't just about crypto adoption or regulatory clarity. It was about weaponizing a digital asset to delay a debt collapse. By backing stablecoins with U.S. Treasury bonds, Washington found a way to artificially sustain demand for U.S. debt while exporting inflation globally. That move, often celebrated as a sign of innovation, is in fact a temporary fix for a deeper structural. If you've made it this far, you know these stories aren't just headlines, they're warnings. Like if you think more people need to see what's really happening. Comment with your perspective. Your voice matters in this conversation. Share this so others can't ignore it. Subscribe for more raw, unfiltered truth about housing, economics, and the politics shaping our lives. Because these aren't isolated events, they're patterns. And the only way to break the cycle is to face it together. Crisis. A $37 trillion debt load spiraling into a doom loop. Interest payments are exploding. Foreign buyers are stepping back. And the only lever left is control the basement of the currency, masked as digital modernization. The bigger picture is far more sobering. While conspiracy theories promise dramatic resets through blockchain magic or hidden gold caches, the real play is more calculated and far more dangerous. It's a slow-motion erosion of the dollar's value, disguised behind digital wrappers and legislative jargon. In that landscape, Bitcoin and gold aren't just investments, they're lifeboats. With no counterparty risk and limited supply, they become the go-to options for anyone looking to preserve value outside the traditional system. As systemic risk accelerates and inflation spreads, understanding this shift isn't just smart, it's essential for financial survival. The United States is barreling toward a financial cliff. The national debt has soared past $37 trillion, and the federal government is now stuck in what economists call a debt doom loop. Interest payments alone are climbing so fast they're devouring the budget. And instead of slamming the brakes, Washington has quietly hit the gas. Because the real plan isn't to pay the debt back. The real plan is to inflate it away. Forget the online conspiracies about erasing debt through blockchain technology or unlocking some mythical gold reserve hidden beneath the Federal Reserve. These fantasies make for entertaining headlines, but they distract from what's actually happening in plain sight. There is no reset button on the global economy. Debt is a legal contract. Defaulting triggers catastrophe. No serious government is even entertaining those theories. What is happening, though, is far more subtle and far more dangerous. Over the past year, the U.S. government has moved to weaponize stablecoins. These are digital tokens pegged to the U.S. dollar. Under new legislation, they're now required to be backed by U.S. Treasury bonds. That means every time someone uses or holds a stablecoin, they're effectively buying U.S. debt. That's not just financial engineering. It's a global strategy. Here's how it works. As demand for U.S. Treasury bond collapses abroad, particularly from countries like China and Japan, the government has turned to a new buyer, the digital economy. The plan is to export stablecoins across the developing world. When these countries adopt stablecoins as their digital currency of choice, they're propping up U.S. debt. It creates artificial demand for treasuries, suppresses interest rates, and buys more time for a debt crisis that can't be fixed. But there's a catch. Stablecoins don't just export American currency. They export American inflation. As the Federal Reserve prints more money and buys more debt, the value of the dollar is eroded at home. And now, through the stablecoin system, that erosion spreads globally. Countries adopting dollar-backed stablecoins are importing that inflation, letting the U.S. quietly push the cost of its fiscal irresponsibility onto the rest of the world. It's a clever move. It's also a temporary one. You can only offload inflation for so long before it comes roaring back. You can only print money and manipulate bond markets before investors begin to see the writing on the wall. And when they do, they run, not toward more debt, but toward hard assets. Assets that don't depend on anyone's promise to pay them back. That's why gold and Bitcoin are no longer fringe plays. They are now the frontline defense against a collapsing fiat system. These are bearer assets, meaning there's no counterparty, no middleman. No one can freeze them, default on them, or print more of them. Gold has thousands of years of history as a monetary asset. Bitcoin just over a decade in, has already become the digital alternative. Both are scarce. Both are decentralized. And both are outside the control of any central bank. As the dollar is debased to manage the unmanageable, it's these assets that hold the line. And the smart money knows it. That's why institutional capital has been flowing slowly, methodically, into both gold and Bitcoin. It's not about timing the market. It's about positioning for what's next. Because when the debt spiral becomes a free fall, there won't be time to reposition. This isn't just about the U.S. either. Geopolitical tension is tightening the screws. China has already imposed export controls on critical resources like gallium and germanium, materials vital to the tech and defense industries. That's not just economic posturing. It's economic warfare. Every escalation, every trade disruption, every sanction increases market fragility. One spark, and the global financial system could face a cascading reset. None of this means panic is the answer. In fact, the opposite is true. The investors who survive the coming storm will be the ones who stay disciplined, who don't chase hype, who don't try to guess the bottom or call the top. Instead, they'll stick to time-tested principles, dollar cost averaging, holding liquidity for opportunity, staying humble when markets get euphoric and patient when markets get bloody, because the greatest returns are often made when everyone else is running for the exits. This is not the time for overconfidence. The system is more fragile than it looks. Markets are brittle, debt is unsustainable, and geopolitical fault lines are widening. Any one of these could trigger a chain reaction. All of them together? That's a recipe for a structural reset, not the sci-fi crypto reset that some internet forums love to peddle, but a real, painful reordering of the global economy, one where hard assets are revalued, currencies are devalued, and only those with resilient strategies come out ahead. The U.S. may continue to delay the reckoning, but it cannot avoid it. The so-called crypto reset isn't a single moment. It's a slow, grinding process already underway. It's a policy of engineered inflation, exported pain, and digital financial control. It's a system that pretends to function while cannibalizing itself from within. And at the center of it, a $37 trillion time bomb that no one in power knows how to defuse. Only delay. And that delay is why investors are waking up. Why capital is flowing to things that governments can't print or freeze. Why people are starting to realize that saving in fiat is no longer saving. It's slow-motion theft by inflation. If you want to protect yourself, forget trying to game the system. You're not going to outtrade Wall Street. What you can do is understand the signals. Own assets that aren't someone else's liability. Keep enough liquidity to strike when fear peaks. And build a portfolio that assumes the storm is coming, not that the Fed will always rescue the market. Because the truth is, the rescue plan is a problem. The entire framework, printing, borrowing, inflating, is what brought us here. Now it's being dressed up in digital assets and sold as modernization. But it's not innovation. It's desperation. The stablecoin strategy isn't about crypto adoption. It's about keeping a broken system alive just a little longer. This is the moment to get serious. To understand that what's coming isn't a reboot. It's a transformation. One that will leave behind those clinging to the old rules and reward those who prepared for the new ones. And preparation starts with clarity. Clear thinking. Clear strategy. Clear allocation. You don't need a crystal ball. You need humility, resilience, and the courage to act before the headlines scream crisis. If you found this breakdown valuable, hit that like button. It helps more people see what the mainstream isn't telling them. Share this video with friends who still think the system is fine. Drop a comment below if you're preparing for what's next, or if you've got questions on building real resilience. And if you want more unfiltered breakdowns on global finance, monetary policy, and crypto strategy, subscribe now and turn on notifications. This isn't over. In fact, it's just beginning. This debt spiral isn't a fluke. It's not some unintended consequence of short-term policy mistakes. It's a feature, not a bug, of how the modern American financial system is designed. For decades, the U.S. government has relied on debt to fund its ambitions, from endless wars to massive stimulus programs to bloated bureaucracies that grow larger no matter who's in power. But we've reached the end game. The U.S. is now in a position where it must borrow just to stay afloat. The Treasury issues new debt to pay off the old. Interest payments are growing faster than tax revenues. In fact, debt servicing is now competing with defense spending and Social Security as one of the largest line items in the entire federal budget. And yet, what's the solution from Washington? More spending, more promises, more printed money. And now, with the introduction of Treasury-backed stablecoins, a new trick, exporting the cost of all this insanity to anyone who dares to use a U.S. dollar derivative in a global financial system. It's not just irresponsible, it's calculated. You see, the government knows it can't rely on China and Japan to keep buying treasuries like they did in the 2000s. The world has changed. Foreign central banks are de-dollarizing. They're looking to gold, to commodities, and yes, even to digital assets that aren't tied to Washington's endless spending machine. So the government is pivoting. If it can't sell bonds to foreign governments, it'll sell them to the digital economy. That's what stablecoins now represent. A hidden, synthetic demand engine for U.S. debt. It's dressed up as innovation. In reality, it's a workaround to prop up an unsustainable system. This is why you're starting to see stablecoins pushed into emerging markets. Nigeria, Argentina, Turkey. Countries plagued by their own currency collapses are now embracing dollar-backed digital assets. And to the average citizen, this might feel like stability, like progress. But it's not. It's just another trap. Because when you hold a stable coin backed by treasuries, you're holding U.S. debt. And when the value of that debt is inflated away, when the dollar is slowly devalued year after year, you're paying the price, whether you realize it or not. Your purchasing power is being drained to keep the American machine running. And let's not forget, inflation isn't just a number on a chart. It's real pain. It's food prices climbing faster than wages. It's rent going up while savings shrink. It's retirement accounts losing ground while Wall Street plays musical chairs with rate cuts and bond yields. The government says inflation is under control. But that's because they redefine the metrics to suit their narrative. Meanwhile, everyday Americans and millions more abroad are feeling the squeeze. And it's not going to stop. Because the only way out of a $37 trillion debt pile is through the back door. Stealth devaluation. This is a real reset. It's not a flashy announcement. It's not a global summit where leaders agree to erase the books. It's a quiet, calculated erosion of trust in fiat money, masked by technology and sold as modernization. But the market isn't stupid. It might be slow, but it's not blind. That's why gold is quietly climbing. That's why Bitcoin keeps bouncing back from every so-called collapse. Because smart investors know this game ends with fiat currencies losing their credibility. And when that moment comes, the exodus from paper promises to hard value will be brutal and fast. Now, does that mean sell everything and go all in on Bitcoin tomorrow? Absolutely not. This is where discipline matters more than ever. The worst thing you can do in a volatile, uncertain environment is overreact. The second worst thing? Do nothing. You need a plan. One grounded in reality, not hype. A plan that recognizes this isn't just about making gains. It's about surviving the shift. Start with cash. Not because cash is a good long-term asset. It's not. But because liquidity is power during chaos. When markets panic, prices collapse. And those with cash can scoop up assets at discounts others only dream of. Then layer in hard assets. Gold, Bitcoin, maybe even real estate in the right markets. Things that don't rely on a government promise to hold their value. Things that exist outside of the central banking cartel. Bearer assets with no counterparty risk. And finally, stay humble. No one knows the exact timing of a crisis. No one can predict the exact trigger. Maybe it's a failed treasury auction. Maybe it's a geopolitical shock. Maybe it's a liquidity freeze in some obscure part of the financial plumbing. Whatever the cause, the effect will be the same: panic, volatility, and a mad dash for the exits. That's when preparation pays off. But preparation isn't just financial. It's mental. You need to be ready for the headlines, the fear, the narrative control. Because when the system starts to crack, the media will do everything in its power to calm the public. to blame the symptoms instead of the disease, to distract you with sideshows while the core structure burns. Don't fall for it. Stay focused on the fundamentals. The U.S. debt is too large to ever be paid off. Inflation is the only politically viable strategy left. Stablecoins are being used to paper over collapsing bond demand. And the only real hedges are outside the system: bearer asset liquidity and knowledge. You might not control what happens next, but you can control how you respond. So ask yourself, are you positioned to withstand a multi-year debt devaluation? Are you holding assets that can survive a regime shift in monetary policy? Are you prepared to act when others freeze? Because make no mistake, most people won't see it coming until it's too late. They'll still be watching the stock market tickers and waiting for the Fed to save the day. But the Fed isn't a savior anymore. It's a hostage of its own policies. Raise rates, and it bankrupts the government. Cut rates, and it fuels more inflation. There's no clean exit, only trade-offs, and eventually consequences. The U.S. government has made its move. It's chosen the path of hidden devaluation. It's using digital tools to kick the can down the road one last time. But that road ends. And when it does, there's no bailout big enough to restore trust in a system that spent decades destroying it. The question you need to ask yourself right now isn't if the system collapses. It's when. And when it does, it won't be a slow, gentle unraveling. It'll be a snap, a cascade, a violent repricing of everything we thought we understood about money, value, and security. This is not alarmism. It's math. Let's go back to the core issue, the U.S. national debt. $37 trillion and climbing. Do you realize how fast that number is growing? We're not talking about decades anymore. We're adding trillions every single year. And now, even minor interest rate hikes by the Federal Reserve are enough to add hundreds of billions in interest payments. This isn't just unsustainable, it's suicidal. In the past, the government could get away with this because interest rates were near zero. Borrowing was practically free. But that era is over. Rates have normalized. The cost of borrowing is exploding, and yet the government continues to act like nothing has changed. Spending increases, entitlements grow, bailouts expand, and underneath it all, a rotting foundation of IOUs that will never be repaid. So what do? They manipulate the denominator. They make the dollars in your wallet worth less. That's inflation. It's not a bug. It's not an accident. It's a policy. And now, with the stablecoin legislation in place, they're exporting that inflation around the world through a Trojan horse wrapped in digital currency branding. Every time someone in Africa or South America uses a dollar-pegged stablecoin, they're holding a piece of U.S. debt. And every time the U.S. government devalues the dollar to manage that debt, it's the entire global population that foots the bill. This isn't a global reserve currency. It's a global inflation weapon. And yes, for now it works. It buys time. It suppresses interest rates. It creates synthetic demand for treasuries. But it doesn't solve anything. It only delays a reckoning. And the longer it's delayed, the more violent it becomes. Here's what that reckoning looks like. A liquidity shock, a failed treasury auction, a sudden withdrawal of confidence in U.S. debt, a wave of sovereign de-dollarization, a geopolitical trigger. Any one of these could set off the chain reaction. And once it starts, the dominoes don't stop. The bond market tanks. The dollar plummets. Interest rates spike uncontrollably. The Federal Reserve panics, slashes rates, and prints trillions in a desperate attempt to restore order. But all that does is trigger more inflation, more capital flight, and eventually, the destruction of what little credibility the system has left. And in that moment, what happens to your 401k? Your pension? Your savings account? Gone. Not because someone stole it, but because you save in a system designed to evaporate value. A system built on promises that require inflation to remain solvent. And that's why gold and Bitcoin are no longer fringe. They're not speculative assets anymore. They're exit strategies. They're escape hatches from a fiat system that's rigged to fail by design. Gold has survived thousands of years of monetary collapse. Empires come and go, gold stays. It doesn't care who's in office. It doesn't need a central bank. It just is. Bitcoin is newer, yes, but it's not a fad. It's code. Scarce, decentralized, and uncorrelated to sovereign debt. It's the antithesis of inflationary policy. And while it's still volatile, because adoption is still growing, its fundamentals are clear. It's money without borders, without rulers, and without built-in decay. Now look, none of this means you should go all in. It's not about gambling. It's about hedging. It's about admitting the system is broken and acting accordingly. You need a plan that works in this world, not the one you were taught in school. A world where central banks are out of ammo, where inflation isn't transitory, it's permanent, where the government's only strategy is to quietly vaporize your purchasing power while telling you everything's fine. This is the age of financial survival, and surviving starts with recognition, recognizing that the old playbook doesn't work anymore. Buy the dip? That only works when the Fed can paper over every crash. Diversify your portfolio? That works until all your assets are denominated in the same collapsing currency. What you need is true diversification, not just stocks versus bonds, but fiat versus hard assets, paper versus bearer instruments, systems that rely on trust versus systems that eliminate the need for trust. Because when trust goes, it goes fast. And we're already seeing the cracks. Confidence in institutions is collapsing. Trust in the Federal Reserve is eroding. Countries are bypassing the dollar in trade agreements. And the U.S. government's credibility is now being propped up by digital IOUs disguised as innovation. Don't think for a second that this ends neatly. The public will be the last to know, the last to react. They'll believe the headlines. They'll trust the bailouts. They'll assume it'll all bounce back. But the next reset won't be a bounce. It'll be a repricing of reality. That's why the most important move you can make right now isn't timing the top or bottom of the market. It's understanding the rules have changed. Do you own your wealth? Do you control your assets? Or are you just another name in a database, hoping the system doesn't lock you out when it breaks? Because when things unravel, you won't get a warning. You'll get a bank holiday, a liquidity freeze, a capital control order. And when you try to move, too late. Gold and Bitcoin don't care about banking hours. They don't freeze. They don't require permission. They just work. So yes, get your cash reserves in order. Get your emergency liquidity lined up. But don't stop there. Think bigger. Think beyond the system. Because the system you've been trained to rely on is the very one that's being hollowed out. And that hollowing is nearly complete. At $37 trillion, the U.S. debt can no longer be ignored. At some point, the illusion breaks. The confidence ends. And when it does, the only people who come out ahead are the ones who saw it coming and acted. So act. Take control of your financial sovereignty. Build resilience outside of fiat. Build strategies that don't depend on the Fed doing the right thing. Because it can't. Not anymore. And while you're at it, don't keep this to yourself. Like this video if it opened your eyes. Share it with someone who still thinks the system is just fine. Drop a comment below. Tell us what you're doing to prepare, where you're allocating, how you're hedging. We read everyone, and your insights might help someone else take that first step. Subscribe if you haven't already, because we're not done. Not even close. This is the new financial war. And every piece of information, every move you make, every asset you hold, matters. Stay smart. Stay liquid. Stay free. We'll see you in the next one.